Hey everyone, today on the final bar, my guest is Tony Zhang from Options Play. We're going to talk about silver, which has been obviously top of mind for a lot of investors, a lot of movement there, but also a long-term play on the equity side that may be worth your attention. Overall, the S&P continuing to push higher after a nice bump higher yesterday, coming out of weakness last week. So the picture potentially has changed a little bit. Big earnings from stocks like Amazon. What does that mean for the long-term trajectory for stocks? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together through the lenses of technical analysis, behavioral psychology, investor sentiment, price, breadth, whatever else we can bring to bear to try to make sense of these markets together. Overall, it's been a fascinating week among fascinating weeks. I feel like for the last year, it's been charting uncertainty, pun intended, and trying to navigate all these different potential drivers that we have. You know, at the end of the day, with so many potential headwinds and tailwinds at any given moment for stock prices, it behooves you as an investor, as a trader, to focus on the message of the markets, to focus on the charts, how they're evolving and what they can tell you. If you do nothing else, if you can identify the trends, follow those trends, and figure out or anticipate when those trends are exhausted, I would say overall, you're going to be on the right side of things. Now, we have some fantastic guests coming through the final bar, as always. I'm excited to talk to Tony, joining us for the first time today, Tony Zhang. Also want to mention some upcoming guests tomorrow. On Wednesday, the 3rd, we have Louis Yanis from WealthNet Investments in Denver. On Thursday, we have Leslie Chuflas. Leslie's the founder of Trading Live Online and a frequent guest host of Your Daily 5, one of our sister shows on StockCharts TV. And then coming up next week on February 9th, which is next Tuesday, we have Javed Mirza. Javed is a technical analyst at Canaccord Genuity in Toronto, coming back to join us again. So a lot of great guests. Look forward to having you along the ride with us as we try to make sense of these markets together. Let's get on to our market recap. As we talk about the markets and how they've evolved from being in a significant uptrend to pulling back last week to now bouncing a bit. The poll question we asked recently is actually kind of topical. Know your technical indicators. Which of these would be considered a trailing stop indicator? And we gave you 4 choices: parabolic studies or parabolic systems, RSI, DMI, ADX. Now, the correct answer, 52% of you got it absolutely correct, which is parabolic systems or parabolic studies. If you know your technical analysis and your technical indicators, you'll know the common thread with all 4 of these. They're all created by the same man, Wells Wilder, who wrote a seminal work on technical indicators in the 1970s. It was one of my first books on technical analysis. I remember using his book to prove out in Excel how to calculate different indicators. That's how I learned things like RSI and DMI. Parabolic studies is designed to keep you in a trade that's working and get you away from trends that are no longer working. It is literally the essence of a trend following indicator. And when you think of a trailing stop, you think of something following along the price with you. And so you have to use things like average true range, or using previous swing lows, using a percent stop, or something like parabolic systems, which again is designed to keep you in the right trade. If you miss that, if you said something like RSI, dig into your technical indicators a little more. You can read Wells's book, or obviously go through our chart school articles on technical indicators. Let's continue on with this market recap. So, the S&P certainly higher today, following through on yesterday's rally, on Monday's rally. Wednesday through Friday last week were really about distribution. And all of a sudden, all these signs pivoted very quickly from risk on to risk off. Even our market trend model, which is based on weekly data, triggered a sell signal in the short-term component to that as of Friday's close. Yesterday and today have certainly been a reversion back to the risk-on trade. And yesterday was a little more narrow. And my friend Matt Maley from Miller Tabak had a great quote this morning. He said, a narrow market is not a healthy market. So there, it was relatively narrow. It wasn't like a huge upswing in volume and broad breadth. Yesterday, it was sort of a narrower lead as the mega cap stocks really were. Today, it feels a little broader. You're seeing a lot of positive movements, things like financials, industrials, and also things like consumer discretionary, technology, and others. So overall, the S&P sort of gapping up today, moving higher, trading off just a little bit in the last 30 seconds, or last 30 minutes. But overall, the positive, the bullish damage had been done, and we so far have had a nice bounce off of the 50-day moving average. It's not just the S&P 500 too. There are a number of stocks, things like Disney and Caterpillar come to mind as big, larger names, mega cap names with a nice bounce so far off the 50-day moving average. And if you want to know the story of this market, I think it's the story of those stocks being able to hold that key price support or not. Do they continue, revert back to the previous highs and push to a new high, or do we break down through the 50-day moving average? I think the remainder of this week will tell you whether that which of those happens. But so far, a day like this certainly feels like any bearishness from last week has dissipated. We're back to stepping on the accelerator. S&P finishing just above 38.25. Mid caps up as well, but not as much. Small caps really weren't a part of this one. They sort of jumped up mid-morning, but then essentially tapered off and really just above the zero level. So this was not back to the small cap, high beta over low vol sort of trade. It was still the mega cap stocks doing a lot of the work here. The VIX continuing to decrease back below 26 now. Looking at some other asset classes very quickly, 10-year yields back above 1.1%. The TLT lower about 2/3%. That basically came at the open. From there, chipped away on the upside, but overall we're seeing higher yields. On the commodity side, again, we'll talk with my guest about silver. Silver coming off again yesterday. This was today after yesterday's bit of a distribution. So this was the latest sort of Wall Street bets Reddit move, jumping higher, but overall going back to the downside. So as we're thinking about silver again, weaker rather than stronger. And again, let's see how the rest of this week plays out on an asset class that has gotten a lot more attention than it had previously. Finally, cryptocurrencies, Bitcoin continuing to move higher. So you're seeing a Bitcoin teasing the 36,000 level, but not quite getting up there. So we'll have to see if it returns there. The all-time high, the long-term high, 42,000, which was an extreme move up there, came off, and now once again starting to appreciate. Let's start with the chart of Bitcoin, and then we'll continue on and look at some other asset classes here very quickly. The chart of Bitcoin in some ways is a masterclass on why Fibonacci retracements are helpful. And I know a lot of people that use Fibonacci retracements on short-term price action, which is absolutely valid and arguably really, really helpful during the trading day. I think there are a lot of, if I was a swing trader, a short-term trader, a day trader, I'd certainly be using them on short-term price action. But even Bitcoin taking the September low and the January peak, you can see we pull back about 38.2%. Retracing that rally, which also was the 50-day moving average. From there, we've pretty much bounced beautifully off of that. So overall, this is actually setting up the continued higher closes, another push higher here. Certainly appears to be setting up to return to the previous highs. I don't see anything on the chart telling me otherwise, unless we break below the 50-day, unless we break below 30,000, which would get us through that last Fibonacci support level. That's when I would start to question this. But at this point, it certainly appears as if support has held, and it feels like, especially on the tactical time frame, the path of least resistance is up. Now, what does that mean on the chart of the S&P 500? We're looking here at the daily chart. And when you look at this, we've talked about the overall uptrend in stocks and how last week really changed the character of the market. So you broke down through a trend line using the previous lows. You came down to the 50-day moving average, which you hadn't really been anywhere near since back here in early November. Now, what's happened next? We've bounced off of the 50-day, and I think yesterday's bounce was a nice acknowledgement of that support level. We've bounced higher again today, which is sort of indicating some potential further upside. From there, it's what's next. And I think one of two things happens now that we're in this range. Option one, we eclipse the previous highs. We break up to 3850, 3900, and continue to push even further, at which point you will hear me, sound the bullhorn and suggest I think we have further upside from here. Or we break down through the 50-day and we start to indicate some further weakness. I think a lot of people are looking to see what happens here to determine whether the next leg is higher or lower. I think as we do move higher, it's really it will be very helpful to look at the breadth readings, because I think you have a chance of establishing a breadth divergence of the price going higher, but the breadth not being as supportive. I would also be looking at the momentum indicators, right? So the RSI on this last move higher here in mid-January had lower RSI, right? So higher move in price, lower peak in momentum. That's a bearish divergence. I think that changes if we get to new highs, but we could have this pattern of successive higher highs in price, successive lower peaks in the RSI. So if and when we would go to above and go to a new all-time high on the S&P, my eye would immediately go down here and see what the volume characteristics are, see what the momentum characteristics are, see what we can understand in terms of other breadth and momentum readings to confirm or deny the breakout that we might have in price. But first things first, you'd have to get to new highs there. Finishing off just very quickly on our market recap, and we have a lot of other things to cover through the course of the show. Worth noting, financials and industrials, number 1 and number 2. That's a little unusual. So some stocks that have been sort of out of mind for a lot of people, sort of reverting higher, and it's worth maybe looking at some of those financial names that have had a meaningful bounce now. On the downside, you have real estate, and then you have healthcare, which was the weakest sector out of the bunch. So healthcare has been a tough one on a relative basis. Don't get me wrong, it's been challenging, but there have been pockets like biotechs and others that have actually started to emerge. So the question for I think that group is whether we're able to sustain a potential move to new highs. That is our market recap for today. Thanks so much for going through all those charts with me. Let's take a quick commercial break. Back with my guest, Tony Zhang. We'll see you in a minute. Hello, everyone. Welcome back to the show. Thanks for joining us every weekday after the close for the final bar. This is Dave Keller here at StockCharts.com, helping you along this journey of analyzing the charts, focusing on the message of technical analysis and the power of stock charts. As a reminder, we're going to do another mailbag a little bit later in today's show. We would love to hear from you. Questions that come up as you're analyzing charts, as you're going through your holdings, as you're making trades, as you're trying to understand these markets. Let us know how we can help point you in the right direction. Shoot us an email with any questions that you have, thefinalbar@stockcharts.com. On our Twitter or on Twitter, just tag us in a comment at finalbarsctv. Finally, on our YouTube channel, just put a comment below the video that you're watching. We'll take all of those questions. We'll get to as many as we can on our next mailbag segment, which will be on Friday's show of this week. I want to welcome on my guest, joining us for the first time, Tony Zhang. Tony's the chief strategist at Options Play, also a CNBC contributor on Options Action, joining us from the New York area. Tony, welcome to the show.
Thank you so much for having me. Really excited to be here talking about stock charts, a resource that I've actually been using for close to 15 years, starting out my technical analysis. You guys were one of the few charting packages that were available for free on the internet at the time.
I was going to say, that is one thing you and I certainly have, besides time in New York, which we were talking about before the start of the show. I think we've both learned in some way technical analysis from stock charts, which is pretty cool. You're joining us now with a couple different themes to look at. First off, obviously top of mind for a lot of investors, given the social media and how it's been in hit, is silver. A big bounce yesterday, lightening up a little bit today. Walk us through, starting with the weekly chart. What are you seeing here?
Yeah, so when I was looking at the weekly chart, I always look at price action first to build my thesis. And you have what looks like a very nice continuation pattern, whether you want to call that a flag or a rectangle that has been building pretty much since April or so, all the way through the breakout level that we just had here earlier this week. This continuation pattern looked like it was going to project higher here. Whether this is driven off of Reddit related momentum or whatever it is, as a technical analyst, we're not so concerned about the why and much more so the what. So we had that push, a breakout, what looked like it was about to break out higher here, that now we know has failed. If we look at this, it had relatively strong relative strength, a rising weekly moving average, and the technical indicator, the PPO that you have on top, was just turning positive here. So you had a lot of confirmation here from technical indicators of a potential push higher. So when we dive into the daily chart to take a look at a potential entry opportunity, this is really where yesterday's big push higher here was the potential. You had the breakout above the April highs of that 2739. It did close below that level, so I was looking for potentially a pullback to the gap level here, about 25.5 for an entry point, which is exactly where SLV opened today, but ended up continuing to trade lower here. So from my perspective, this at the moment is a failed breakout here. Now, as an options trader, I do like the fact that this stock SLV went from about 28 bucks yesterday to high to about 24 and a half on today's close. For me as an option strategist, I like to sell puts in this type of environment where you have a large amount of volatility. You can take advantage of that by selling puts. You were able to collect fair amount of premium here on a strategy like that. But for now, I'm more neutral rather than bullish at the moment.
So we're neutral on silver. Going through maybe to a different group here. When people think automobiles, a lot of eyes have been on Tesla in the news and with the trajectory, but it's not the only automaker out there. Talk us through GM.
Yeah, I've been a big proponent of GM, especially for those of you that like electric vehicles, just from a valuation perspective, not trading at those eye-watering valuations that you see Tesla and some of the Chinese electric vehicle companies trading at. I started building a case for this stock at around $30 when it started to break out above that 40-week moving average. As you see here back here in early April, you had the breakout above that 40-week moving average, came back to retest it as support around that 28.5 swing low and just continue to push higher here. And recently breaking above the post bankruptcy highs, which are around $40 or so. So when you had that breakout, came back to retest that level as support, that really confirmed for me what is a 9-year breakout here for this particular stock. And you can see that stock ran very quickly from $40 to 57, roughly 57 or so. And you have that pullback here. And this is on continued relative strength. On that relative strength, as you can see, that chart here on the bottom continues to outperform against the S&P. So each successive high is confirmed by that relative strength. So that's exactly what I like to see on a big picture chart. And then when we zoom into the daily chart, what you have is a very strong pullback here over the past couple of weeks into that $48 area. It didn't quite get back to the 46.7, as you can see, which was that last swing high. You got a quicker pullback, but it was also a very fast move from $40 to 56.5. You got that retracement and you have a nice bounce off of it. So from my perspective, with a strong technical rank of 97, strong money flow, this all points to me for further upside. I'm targeting at least 57 here to the upside, and then for me, this is a long-term perspective that I have on this stock. So I like this particular entry point for a continued move higher here for GM.
That's a great set of charts, Tony, and I love you talking through that last example and really looking at GM potentially returning to previous highs, if not further, building on some strong upside momentum. Tony, it's so good to have you on the show. I hope we can have you on again. Until then, stay safe and be well. We'll talk to you soon.
Thank you so much. Thank you for having me.
That's Tony Zhang. Tony's the chief strategist at Options Play based in New York. And I love it as he was talking through showing the weekly and the daily charts. I hope what you drew from that is what I did. Number one, I love how we talked about the first two charts of silver and sort of working through an example where we saw one thing happen, something totally different happen. And how do you regroup from that? How do you make sense of that? And thinking about how your thesis should change when the evidence supports it. And then finally, looking at the charts of GM, it's hard to deny. I mean, the long-term setup, absolutely agreed. And if you think nothing else of a stock like GM, higher highs and higher lows are an uptrend. I think we might have T-shirts made. My wife was joking about just putting higher highs and higher lows, because when my wife listens to me doing the show, I say it probably 50 times an episode if I'm getting in a rhythm. But that's sort of what you're seeing with something like GM. As long as that pattern continues, the uptrend is in place, and it's worth following charts like that and assuming that that trend will continue until proven otherwise. Great take from Tony Zhang, and really good to have him on the show. Let's continue on with the final bar mailbag. As I've mentioned many times, one of my favorite parts about this show is the interactive nature of it. It's a pleasure to hear from all of you, and specifically questions that you're running into. How can we help you be a better investor, a better trader, a better decision maker, a better technical analyst? And again, please let us know how we can do so. Shoot us an email and we'll get to more of your questions on Friday. Question number one. Love the final bar. Your consistent process has really helped my decision process. It's great to hear, and you're absolutely welcome. Regarding the S&P 500, you mentioned in the last 2 days since the drop to watch for break of swing low. Question one, how do you define quote unquote swing low? And question two, has the S&P 500 not already broken swing lows at 3,800 and 3,750? Next low is 3,670. Why is this the relevant swing low and not the other ones? Great question, and apologies that my chart is becoming busier and busier. You can tell, I think, when the market is becoming not challenging, but maybe, when it's at an inflection point, because I start drawing a lot more lines because you're trying to get a read on things and think about, where's the line in the sand at which point you have to revisit a thesis. And so, being sort of bullish and seeing the constructive pattern, seeing a potential breakdown means I end up drawing a lot more lines on the chart to try to make sense of it and try to anticipate at what point you decide that we have to pivot from risk on to risk off in terms of thinking. So, your question was how do you treat these lows, right? What is the most swing low? So for me, when I say something like the most recent swing low, it is very much a shorthand. It's a relatively subjective measure. And for me, it depends on the time frame you're looking at. So on an hourly chart, something like 3,800 might be a really meaningful level. Something like 3,750 might be really meaningful because on that time frame, those are key turning points. It's all about what makes sense for the time frame you're looking at. When I'm zooming out and looking at the last year on a daily chart, I'm sort of identifying the highs and lows. There's the thrust higher, there's the pullback, there's the thrust higher, there's the pullback, and my mouse is sort of identifying sort of those key levels. And for me, clusters of levels, when a level is tested a number of times, that sort of adds value. When there's a confluence of levels, I think that's really, really helpful. So, when I've talked about like 3,650 or so, it really comes down to this confluence of support. The lows in December, which was sort of the launch pad before the big move higher that I think, arguably ended in mid-January, that lines up with the 38.2% retracement of the October to January rally as well. So you have two different sets of indicators calculated differently, honing in on that same level of support. I think that's why that level has meaning. I think remaining above there, and the 50-day is certainly an important one as well. But for me, remaining above 3,650 is part of that. Things can still be bullish thesis. We break below there, I think you really have to question the potential for further downside, looking for how you would invest if the market goes down to 3,200 and what you would be comfortable with in terms of tactical movements and raising cash and all of those sorts of things. So that's why I would think of them. Again, it is all relevant to your time frame. If you're a shorter term investor, other levels between there might actually be way more helpful. And I would argue look at something like an hourly chart to get a better sense of those. Next question, the scooter rankings for stocks. What is the basis of these? Is it price action over a period of time? If so, what period? Is it price increasing the most and decreasing the least over the period? I noticed NIO is the current number one, but the price has been consolidating. How can it still be number one? A lot of great questions in there. I'll summarize the answer as much as possible. So I often refer to the scooter rankings. This is the list of top 10 stocks. We can also look at some of the other ones. I often look at which ones have gained the most in their scooter ranking. So a couple things I will tell you. Number one, remember this is a percentile ranking. So if every stock in the US all went down 1%, the scooter rankings would probably remain almost identical, right? Because they're relative to each other. Now, that's not entirely true because they're based on technical indicators, which might change a little bit depending on what happens. But if the whole market, if everything moved in tandem up or down, these rankings wouldn't change a lot because it's based on how things are relative to one another. So that's one thing to remember. The other thing is there are actually three different time frames. So if you look at the chart of NIO, you're absolutely right. Stocks that have been at the top are actually pulling back a little bit. But here's the thing. This is a stock that has had an incredible run on a relative basis. So if you look at the price movements on a relative basis, it scores much better than other stocks because of that. There are a bunch of components that are baked into the scooter rankings. And there's a long-term component, which is about 60% of the model. I'm remembering vaguely from looking at it. I think it's about 30% on a medium-term time frame, about 10% on a short-term time frame. I might not be 100% on those percentages, but it's about that, which means that a majority, over half of the weighting, are longer-term charts, which means a stock can pull back. There can be movement, and the scooter ranking isn't going to change as much because it's not driven just by the last movements. Otherwise, the scooter rankings would change very quickly if in a volatile market. They're not designed to change that actively. They're designed to be more acknowledging the longer-term trend strength, and that's why NIO is still very positive. If you want to know more, we actually have the algorithm listed out in detail. Click on the magnifying glass, type scooter SCTR, and you'll see the Chart School article that explains it in detail. Next question, really curious if you can do AT&T. They have a complicated chart and haven't participated in the recovery, trying to understand why it's so bearish from the charts. Thanks, David. Keep up the great work. And thanks for that. I'll do my best. Looking at AT&T, so a couple things I would say on the chart. I would used to joke with some of my former analysts at Fidelity. We would talk about stocks that just didn't chart well, is how we would describe it. And I remember Microsoft being the perfect example. If you look in like the late 2000s, early 2010s, these things, Microsoft would just chop around. It would just have these failed breakouts, failed breakdowns. It was just sort of range bound. It was just this boring, not charting well type of stock, really not a trend. And in some ways, AT&T has sort of become the new Microsoft in terms of it, quote unquote, doesn't chart well. So a couple things I will tell you, number one, when you're looking at a high dividend yield paying stock like this, you have to remember the impact of dividends. So if you look at like a weekly chart and you go back 7 years here, right? This is unadjusted, or sorry, this is adjusted for dividends. If you put the little underscore, that actually takes the dividend component out of there. You can see that the trend has actually been downwards, right? The overall trajectory, AT&T is trading at, multi-year lows, if not decade-long lows. When you take the impact of the dividends out and focus just on the behavior, it's not as bad, it's more mid-range. So something like this, putting an underscore before the ticker can help you a little more in terms of understanding the short-term price dynamic. And that's one thing I would tell you. So underscore T basically shows you what the actual price was at some of these different times. And here what you can see is just the directional price movement has not been very good. It's continued to be range bound. If you look from March, after the March sell-off, it rallied into the beginning, the end of March. And from there, it literally has gone nowhere on a price basis. These little gaps are the dividends that are paid out from AT&T. And other than that, it just really hasn't done anything. So if you're looking for trend, it's not there. If you're looking for long-term performance, it's certainly not there. The question for something like AT&T, can it recover? Can it generate some long-term relative performance? But if you look at the relative chart, it has been weak. Until that line turns higher, it's hard for me to look at something like AT&T as anything but basically a really good savings account where you're losing money on the overall value of it, but getting a decent yield. I don't know if that's the best option when so many stocks are at or near new all-time highs. That's all the time we have for questions. There's some deep questions I wanted to make sure I covered. We have some more and others that we'll get to at the end of the week, and please keep them coming. We would love to hear from you and answer one of your questions on the air. We need to wrap the show. Go to the 3 and 3 charts. 3 minutes. Here we go. Chart number one is the S&P, and it's looking at the daily advancers and decliners. We often look at this in a cumulative form, the cumulative advanced decliners. But I think it's also worth noting, looking at the individual day-to-day movements and seeing what's happened. So the last 2 days, you've had about 75% advancers and 25% decliners. So 3 out of 4 stocks going up every day. If you look, other times where we've had a pullback in price and then they bounce higher with about 75% on multiple days, there are 2 times that jump out at me. Number one, late September, which was after the September pullback. The other one was early November after the October pullback. Now, I'm not ready to say that we've now done this and we're going to resume the move to new highs. I don't think this took enough time for that. If you look, these were 3 to 4 week corrections. That was like a less than 1 week correction. So I think just in terms of the timing of how things normally trade, I don't know if that was enough. However, it's worth noting that stocks are rallying pretty well out of those depressed levels. Chart number 2 is Amazon. Amazon reported just after the close. So as we're recording this, we're getting the update on what happened. We'll have to see how the price reacts afterwards. But overall, this is a chart absolutely to watch. The FanMag stocks, the FANG stocks have been a key set of themes to pay attention to. When you look at the move higher, you're seeing a chart that's essentially range bound. But if you look, lower highs, higher lows, and now we're starting to see more and more higher lows and a break to a new swing high. This previous high from the last couple of weeks, we've now bounced back above there, and I'll be interested to see if the earnings today are enough to propel that to further upside. Finally, we have Caterpillar, CAT, and I think it's worth noting stocks like Caterpillar, stocks like Disney are bouncing off their 50-day moving average. For me, if I'm not looking at a chart of the S&P, I'm looking at how charts like this bounce off of the 50-day. Do they hold that? Or do they break down and go to new swing lows? I think those are the charts to watch. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final hour. It's a pleasure to walk through these markets together and share them with you. Special thanks to my guest, Tony Zhang from Options Play, joining us from New York for the first time. Great thoughts on 2 key tickers I think a lot of us are paying attention to. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.